If you've been hearing that the yield curve is finally back to normal, that's not the comfort it sounds like. After more than 2 years of inversion, the longest stretch on record, the curve has just flipped upright again. And if history is any guide, that's when things usually start to break. It happened in 2007, just before the financial crisis, in 2000, months before the dot-com crash, and even back in 1929, right before the Great Depression. Each time, investors relaxed as soon as the curve normalized, thinking the worst was over, and each time, that moment marked the beginning of the downturn. What's playing out now follows that same pattern. The curve that warned of trouble for 2 straight years has finally turned, and the market is celebrating. Stocks are climbing, optimism is back, and most people are convinced the danger has passed. But history says this is the stage when the risks shift, from the signal itself to the real economy. So if this pattern has been accurate for nearly a century, what is it showing us now? And could what's coming be even worse than 2008 and 1929 combined? In this video, I'm going to break down exactly what's happening and why this signal matters more than ever today. You'll see how the yield curve works, why every major inversion has predicted an economic slowdown, and what's different about this one. We'll look at how this cycle compares to 1929, 2000, and 2008, why the job market always looks strongest right before it weakens, and how debt, corporate refinancing, and even commercial real estate fit into the bigger picture. By the end, you'll understand the full story behind this signal, not just what it means for markets, but what it means for everyday people, businesses, and the future of the economy, and why ignoring it this time could be the biggest mistake yet. But before we decide whether this time is truly different, let's unpack what this signal really represents, and why it's been so accurate for nearly a century. Let's strip away the jargon and talk about what the yield curve really tells us. Every day, the US Treasury borrows money by issuing bonds, some that last a few months, others that stretch 10 or even 30 years. Normally, the longer the loan, the higher the interest rate, because investors want extra reward for waiting and for taking on long-term risk. That's what we call a normal yield curve, an upward slope from short to long maturities. But when short-term rates climb above long-term ones, the curve flips. That's an inversion, and it usually happens when the Federal Reserve keeps rates high to slow down inflation, while investors believe the economy won't stay strong for long. At that moment, the bond market is basically saying, the Fed's foot is still on the brake, but the road ahead looks rough. Now here's where it gets interesting. The curve isn't predicting recessions by magic. It's reflecting expectations about jobs, spending, and credit. When borrowing costs rise sharply for businesses and consumers, people pull back. Companies stop hiring, and investors rush towards safer, longer-term bonds. That demand pushes long-term yields down, while the Fed keeps short-term rates up. That's the recipe for inversion. And history shows it works as a warning system because the curve captures something few other indicators can. It measures confidence, fear, and timing all at once. It's not just about interest rates, it's about how the market sees the future compared to the present. That's why central banks, including the Fed itself, track 2 versions, the 10-year minus 2-year spread and the 10-year minus 3-month spread. The second one, the 3-month version, has predicted nearly every US recession since the 1960s with remarkable accuracy. Right now, that model still shows elevated recession risk even though unemployment is low and the stock market looks healthy. So before we decide if today's re-steepening means recovery or danger, we need to compare what the curve is showing now to what it showed before the major downturns of 1929, 2000, and 2008. If the yield curve has flashed warnings before every major downturn, the obvious question is, what makes this one different? In one word, duration. The most recent inversion didn't just appear and fade. It stayed inverted for over 2 years, the longest stretch since reliable data began in the 1960s. That means short-term borrowing costs stayed higher than long-term rates for longer than any generation of businesses has ever faced. Every day that gap stayed inverted. It drained liquidity from the system. In 2006, the curve was inverted for about 7 months before the housing bubble burst. In 2000, roughly 11 months before the dot-com crash. In 1929, the inversion lasted just under a year. Today's 2-plus-year inversion dwarfs them all. But duration isn't the only difference. The financial backdrop is completely unlike anything from those eras. In 1929, household debt was small compared to income. In 2008, the leverage sat in housing and banks. Today, it's everywhere. Governments carrying record deficits, corporations loaded with cheap debt that's now rolling over at twice the cost, and households juggling record credit card balances. According to the International Institute of Finance, global debt hit roughly $338 trillion this year, the highest in history. At the same time, the term premium, the extra yield investors demand for holding long-term bonds, has surged to its highest level in years. That's keeping long rates stubbornly elevated even as inflation cools. Put simply, even if the Fed starts cutting short-term rates, the rest of the curve may not follow. That hasn't happened in any prior cycle to this degree. So when people say the curve has normalized, what they really mean is the inversion ended because long yields rose, not because short rates fell. That's a key distinction. It means financial conditions haven't actually eased, they've just shifted where the pressure sits. In other words, instead of a sudden pop like 2008, this cycle could deliver a slower, broader squeeze across households, corporations, and governments at the same time. And history shows when the pressure spreads that wide, it rarely fades quietly. It compounds. To see why that matters, we need to look at how similar relief rallies have played out before the real downturn hit. Every yield curve inversion tells a story, but not every story unfolds right away. Sometimes the market looks like it dodged a bullet until it doesn't. Economists call it the whipsaw pattern, a short-term relief that tricks everyone into believing the danger has passed. It's happened several times in modern history, and each time the pattern was almost identical. Take 1989. The curve inverted early that year, sparking recession fears. Then it steepened again by summer. Investors relaxed, stocks rallied, and analysts started calling it a false alarm. A year later, the US slipped into a recession that caught nearly everyone off guard. Fast forward to 1998, the curve briefly inverted during the chaos of the long-term capital management crisis. When the Fed stepped in, the curve steepened again, markets surged to new highs, and investors declared victory. Within 2 years, the tech bubble burst. Then 2006, the example most people remember. The curve had been inverted for months, the housing market was overheating, and yet by mid-2007 the curve started to steepen. Commentators called it a soft landing. A few quarters later, the global financial system unraveled. That's what makes today's setup so tricky. The curve has just turned positive after a record inversion, and once again optimism is creeping back in. Equities are up, unemployment is still low, and people are saying the worst is behind us. But that's exactly what they said in 1989, in 1998, and in 2006. The whipsaw doesn't mean a crash is guaranteed. It means the signal often resets expectations before the final stage begins. Historically, recessions start after the curve normalizes, not during the inversion itself. So when you hear the yield curve is uninverting, it's not necessarily good news. It can be the moment the market shifts from warning mode to impact mode, the point when tightening that began years earlier finally starts to bite. And this time the combination of record debt, fading savings, and stubbornly high rates gives that pattern more fuel than it's had in decades. Which brings us to the next question. How does this signal tie in with jobs, the one part of the economy that still looks unbreakable? If you only looked at the job market right now, you'd think everything is fine. Unemployment is low, payroll growth has been steady, and wage gains still outpace inflation in several sectors. That sounds healthy, and it is, until you realize that's exactly what the data looked like right before every past recession. The yield curve doesn't just predict downturns, it leads the labor market by months or even years. When the curve inverts, it signals that credit is tightening, but it takes time for that to reach hiring managers and payroll numbers. Companies don't cut jobs at the first sign of higher rates. They wait. First they freeze hiring, then they slow expansion, and only later do layoffs begin. That's why the economy usually feels strongest right before it weakens. We can already see the early cracks forming beneath the surface. The SOM rule, a simple recession indicator based on unemployment trends, triggered in mid-2024. It does that when the 3-month average jobless rate rises at least half a percentage point above its recent low. That doesn't mean millions of layoffs overnight, it means momentum has shifted. The rate of improvement has stopped, and the climb has begun. If we line this up with history, the pattern repeats with eerie consistency. After the 2006 inversion, unemployment stayed near cycle lows for almost a year before rising. After 2000, it took about 9 months. In 1989, the lag was roughly the same. So when people say the curve inverted ages ago and nothing happened, They're ignoring that the job market is always the last to turn. There's also a psychological element. As long as people feel secure in their jobs, they keep spending, which delays the slowdown. But once layoffs start, sentiment slips fast. Spending drops, credit card delinquencies rise, and businesses pull back even harder, creating a feedback loop the Fed can't easily stop. That's why tracking jobs isn't about counting layoffs, it's about recognizing when the direction changes. And right now, that direction has turned. The curve is telling one story, and the labor data is starting to agree. The next step is to look at what's propping consumers up despite that shift, and why those buffers might not last much longer. For most people, recessions don't start on Wall Street. They start at the kitchen table. You feel it when groceries eat more of your paycheck, when credit card balances don't shrink, and when refinancing your mortgage suddenly costs twice as much. During the pandemic, Americans built up over $2.3 trillion in extra savings. That cushion delayed the pain when rates began rising in 2022. People kept spending, businesses kept hiring, and the economy held up. But that buffer is gone. The Federal Reserve and the San Francisco Fed confirmed that those savings were mostly depleted by early 2023. And BEA data shows the personal saving rate is now near 4.6%, well below pre-pandemic norms. The strain is showing. Credit card balances are at record highs, and delinquencies are rising fastest among younger borrowers. Student and auto loan delinquencies are climbing too. Most homeowners are shielded by low fixed mortgages, but new buyers face costs 70 to 80% higher than in 2021. Mortgage rates have more than doubled since the ultra-low era of 2021. If households are the first to feel tighter credit, companies are next, and the timing couldn't be worse. Over the past decade, businesses borrowed heavily at rock-bottom rates, issuing bonds and floating-rate loans because debt was cheap. That era is over. Now much of that debt is coming due in what analysts call the maturity wall, a massive wave of refinancing between 2025 and 2028. According to Moody's, the heaviest pressure falls in 2028, but cracks are already showing. Companies that once borrowed at 3% are now refinancing at 6% or more. For firms with thin margins, that's the difference between profit and loss. The weakest spot is in leverage loans, used by smaller or highly indebted firms. These reprice quickly as rates rise. Fitch now puts the leverage loan default rate around 4.8%, while high-yield bond defaults are near 3.3%. The agency expects defaults to climb toward 5.5% to 6% for loans and around 4% for bonds, roughly double the long-term average. The bigger danger isn't just defaults, it's the lack of refinancing options. In 2008, credit eventually returned. Today, even strong firms are paying historically high spreads. That means investors are demanding more to take risks, a clear sign of tightening. Even B-rated companies now earn barely enough to cover interest, with coverage ratios near 1.5. A small dip in revenue could tip them into distress. This isn't a sudden collapse like 2008. It's a slow squeeze, eroding margins, cash flow, and credit quality across thousands of companies. And when that happens, the next domino usually falls in commercial real estate. If you want to see financial pressure unfold in real time, look at commercial real estate, where higher rates, tighter credit, and post-pandemic shifts all collide. The tracks are clear. TREP reports that CMBS delinquencies have climbed to about 7.29%, the highest in more than a decade, driven mostly by office properties. Vacancies in major cities now top 20%, and in some downtowns, nearly 30%. Buildings once worth $100 million are selling for half or sitting empty. The math just doesn't work anymore. Properties financed at 3% are rolling into 6 to 7% debt with fewer tenants and weaker rents. Even solid owners are struggling to refinance without adding new capital. Multifamily housing, once considered untouchable, is showing strain too. Pandemic-era construction flooded markets, rent growth cooled, and developers with short-term loans now face higher costs and reluctant lenders. Roughly 60% of commercial loans sit on bank balance sheets, much of it with regional lenders already hit by deposit outflows and bond losses. Defaults are rising, and special servicers are handling volumes unseen since 2008. Real estate moves slowly, which makes it look stable, right until it isn't. The only question now is whether these cracks stay contained or start spreading through the wider credit system. The first thing to understand about this cycle is that it's not 2008 all over again. Banks aren't stuffed with toxic mortgage securities, and they're far better capitalized. The Fed's 2025 stress test showed every major bank staying above required capital even in a severe downturn. That's good news, but the risks haven't vanished. They've shifted. After 2008, tighter rules pushed leverage out of banks and into private credit funds, REITs, hedge funds, and shadow lenders, which now holds trillions in corporate and real estate debt, with far less oversight. Meanwhile, regional banks, which still hold about 60% of commercial real estate loans, remain vulnerable. Their 2023 failures prove liquidity risk can strike fast, and rising rates left banks sitting on over $400 billion in unrealized bond losses, according to the FDIC's mid-2025 report. So yes, big banks can absorb shocks, but the next break might come from outside them, in the credit network holding everything together. For 2 years, investors have obsessed over one question: when will the Fed cut rates? The assumption is simple. Once the Fed cuts, borrowing costs fall. That's what usually happens, but this time maybe not. The reason is the term premium, the extra return investors demand for holding long-term bonds instead of short ones. It's like uncertainty insurance. When the world feels stable, they accept lower yields. When inflation, deficits, or geopolitical risk rise, they want more compensation. So even if the Fed cuts short-term rates, long yields might not follow, and could even rise if markets fear renewed inflation. Easier policy won't automatically mean cheaper money. It might just shift where the pressure shows up, a force still pulling on an economy heavy with debt and short on savings. So far, we've focused on what could go wrong, but a full picture also means understanding what could go right. And to be fair, there are reasons why a deep recession isn't guaranteed. For one, the US economy has proven more resilient than almost anyone expected. After 2 years of rate hikes, consumer spending is still growing, wages are steady, and inflation has eased without a surge in unemployment, the definition of a possible soft landing. Corporations, though more indebted, acted early. Many refinanced before rates peaked, pushing maturities into 2028 and buying time. That's why defaults are rising slowly, not spiking. Big banks are also stronger. Capital ratios are high, and regulators have moved quickly to manage stress in CRE and small banks. Labor markets help too. Post-pandemic shortages made companies reluctant to lay off workers they struggled to hire. Meanwhile, technology and productivity gains are cushioning costs and improving flexibility in logistics, software, and energy. So yes, the yield curve warns of stress, but not destiny. If credit policy and consumer demand hold steady, the landing could stay soft. The real test is timing, and that's the one variable no model can predict. Soft landings have always depended on timing, and timing in economics is where most cycles fail. That's why, even as we acknowledge the upside, it's worth watching the data that tells us when resilience starts to fade. If you want to know where we are in the cycle, not what the headlines say, but what the data says, there are 7 signals worth watching. 1. The 10-year minus 3-month yield curve, the Fed's preferred recession model. When it climbs back towards zero after a deep inversion, that's historically when recessions begin. 2. The 10-year minus 2-year spread, faster and market-driven. A rapid steepening while short-term rates stay high is a red flag. 3. The SOM rule, triggered when unemployment rises 0.5 points above its low. It flashed in mid-2024. If it drifts higher, that's the confirmation signal. 4. The personal saving rate, now around 4 to 5%. Lower means households have less cushion. 5. Consumer delinquencies, tracked by the New York Fed, rising debt stress on Main Street. 6. Corporate defaults. If leveraged loan or high-yield defaults top 6%, pressure spreads to markets. 7. The term premium. If it stays high even after Fed cuts, long-term borrowing costs remain heavy. Together, these signals map the economy's real direction, before the headlines catch up. Every generation believes their economy is different. In 1929, it was a new technology and endless productivity. In 2000, the internet revolution. In 2006, the belief was that housing prices would only rise. And in 2025, it's artificial intelligence and the idea that the modern economy is too dynamic to fail. That belief isn't arrogance, it's human nature. We want to think progress rewrites the rules, but markets don't run on optimism or innovation. They run on credit, confidence, and the same cycle of fear and greed that's always driven them. Every downturn looked calm before it hit. Low unemployment, high stocks. Experts say this time is different. When the surface looks fine, people stop listening to the signals. That's why the yield curve matters. It's not emotional or political, it's math. And today that math is flashing the same warning it always has. It doesn't guarantee a crash, but it does warn of complacency. The rules haven't changed, only the setting has. The moment people believe the cycle is tamed, that's usually when it resets. If history proves anything, it's that no one times the cycle perfectly. Even the experts who called past crises early looked wrong, until suddenly they weren't. The goal isn't prediction, it's preparation. Recessions unfold in layers: first credit, then earnings, then jobs, then confidence. By the time headlines say recession, the damage is done. The edge goes to those who spot the shift early and stay calm when others panic. Each downturn feels different, but the response is timeless. Stay patient, stay disciplined. Every correction resets the opportunity. The yield curve doesn't predict doom. It reminds us that cycles are constant, and those who prepare early don't just survive them, they come out stronger. The next phase has already begun, where the signals stop warning and start breaking. Click the video on screen to see how it all plays out.